India is poised to exit its FY24 year with a 7% GDP growth. That makes it one of the fastest growing economies in the world. At this current 6 to 7% growth rate, it is not only one of the faster growing economies in the next 2 or 3 years, it will put it in line to become the third largest economy in FY27. The drivers for this growth are plenty, not least because of India's demographic dividend and ability to use technology to stitch up its economy, and ability to offer tech services for the rest of the world in an increasingly high-tech world, but also an external one to do business in India to shift certain manufacturing capacities into India. While the underlying fundamentals are solid, the often asked question about investing in the India market today is whether it is too expensive and whether markets would fall because of valuations. Clearly, the Indian market is one of the better performing markets in the last 2-3 years. In FY24, it has given roughly about 30% gains. Over the last 4 years, from March 2020, it has given a compounded returns of 29%. That has not totally come with a valuation expansion angle. It has come also because earnings have grown at a compounded rate of 22% in that period. We believe that the premium valuations can sustain for 2 reasons. One is superior earnings growth. All over the world, equity investors do tend to flock to countries or stocks with superior earnings growth. And that place today is India. The earnings growth is backed by various reasons, from increasing exports and ability to tap into a growing pool of consumer and the ability to raise margins as they manage to upsell higher value products. The second reason is growing domestic liquidity. In all countries, domestic investors tend to invest in stocks that they know best. In India, as a growing pool of consumers becomes rich, there is excess savings. We've seen the excess savings being channeled into domestic mutual funds as well as domestic trading accounts. Domestic investors have become an increasingly important component of the fund flow in the India market, to the extent that when foreign investors were pulling out liquidity from the market in some months last year, the market continued to sustain its rally. The current bull market started in March 2020, first starting with the IT services sector, as a lockdown world significantly increased the demand for such services. It filtered into the metals and the industrial world, reflecting a decade of low capital expenditure in India. It subsequently filtered into manufacturing and chemicals as the world started to look on India as an alternative location to provide these products, where China had been a big producer of. The financial sector has its year of outperformance in 2022, when global interest rates were perceived to be on the rise. That gave way to the current rally in small caps, property, and government-owned stocks, partly because of valuations, but partly also because of the depleting supply of excess property inventory. This healthy sector rotation is good for the market because not all parts of the market is expensive at the same time. It gives rise to new themes to emerge, and it gives rise for the bull market to continue.